Morning, Steve Freed in Chicago. It's Friday morning. I'm here, but my video technician is not. So I'm actually recording this on Wednesday. And there's a couple of things that I wanted to talk about. First of all, the soybean market is trading two different fundamentals. The nearby U.S. market is tight. Prices should be supported. Long term, assuming normal South American weather and U.S. weather in 2014, prices will eventually go lower. In the corn and wheat market, most everybody is bearish. The funds are short, and we're looking for 2014 crops to be normal and add to the supply, which should push prices even lower. What I'd like to take a little time is to talk about options. The first slide just kind of shows you that if you are buying a call, you're giving the right to be long the market at a strike price above where futures are. It's a bullish position. If you're buying a put, you're looking at the right to be short futures below where we're trading at a particular strike price. If you're long a call, the only way you're going to make money is if the market trades higher and goes through your strike price. The only way you're going to make money being long a put is if the futures go lower and trade below your strike price. You pay a certain premium to be either long a call or long a put, and that's all that you're going to lose in this position. Now, some people look at it as using options for insurance purposes. Let's say that you want to sell grain, but you want the right to be long above the market. You buy a call. And let's say you don't want to sell grain, and you want the right to be short the market if it goes lower, you buy a put. The next slide basically looks at corn market. For 2014, we're looking at prices that have dropped from last year. This is a weekly corn chart. The first line shows you where Central Illinois farmers look at, including land costs, your cost break even. So if you sell cash and you buy a 470 call right now for July, you're paying 19 cents for it. But on March 1, if corn futures are 20 cents lower, that same call will be worth 5 cents. So why not think about selling some cash, whether it's 2013 crop or 2014 that you're going to plant in 2014, and replace it with a call. The next slide shows the same thing in soybeans. Basically, the weekly soybean chart is right between what we project 2014 cost break even is and the strike price of the 1470 July call. It's about 20 cents for the call. And on March 1, if futures are 50 cents lower, that call is also going to be worth a nickel. So how about selling some of the either 2013 beans or 2014 beans that you're going to plant and replace it down the road with a call option? You can also look at these two charts and say, well, what if I want to buy a put below the market? Fast forward to March 1st, futures, corn is down 20 cents, beans down 50 cents. We'll take a look and see, especially in beans, what's the best put to buy. Because people feel that in 2014, if everything goes right, beans are probably worth $9. Looking way ahead down the road, as far as corn, 2014 people think, assuming normal weather, corn's worth $3.80, and by 2015, another good crop, and corn's worth $2.75. So it's good to think ahead, have a plan, look at your returns on investment, look at your cost, and maybe use options in 2014 to protect either grain that you want to sell, if in case the market rallies, or grain that you don't want to sell, and in case prices decline. As always, these are my thoughts and not those of ADM or ADM Investor Services, and have a safe and profitable trading day.